Welcome to Pierpoint Perspectives, the Securities Finance podcast delivering commentary from the best, brightest and most innovative people in the world of securities lending, repo, collateral management and related areas. Pierpoint Perspectives is brought to you by the consulting team at Pierpoint Financial. So now, over to your hosts.
Hello and welcome to episode 10 of Pierpoint Perspectives. I'm Roy Zimmerhansl, I'm your host and practice lead at Pierpoint. Today's guest is amongst my longest contacts in the business. We had our first conversation in 1992 when I'd just been asked to move into securities lending full-time by Chase Manhattan Bank. I'd been involved on the sidelines while running a custody relationship management team, and the bank wanted to focus more heavily on securities lending. I called various borrowers to introduce myself, and today's guest kindly invited me for breakfast at Goldman Sachs, where he was at the time. After the breakfast, a few days later, he told me they had real difficulty getting the head trader to join us because he didn't want to waste his time with yet another agent lender. I feel like I've had a small part in my guest's career. I invited a number of our borrowers to join me at the varsity match, a traditional rugby rivalry between Oxford and Cambridge. A couple of months later, I learned that my guest had sealed the deal to move to Lehman Brothers with his new boss at that match. But my guest had bigger fish to fry. Striking out with another Lehman employee, Charlie Stopford-Sackville, the two of them bravely set up Spitalfields Advisors, the first firm I saw that focused on consulting in securities finance and really the role model for what I'm doing today. In 2002, the pair launched Data Explorers, which helped revolutionize the securities lending business, enabling the market drive towards market-driven decision-making rather than finger in the air or just experience alone. Data Explorers was subsequently acquired by Market in 2012. After taking some time out, my guest launched a new venture, Credit Benchmark, with Donald Smith, who became CEO of Data Explorers in 2008, and I'm sure we'll be talking about that today. Finally, my guest was recently a moderator for one of the sessions at the groundbreaking Global Investor ISF and ISLA webinar series, and I had the pleasure of interviewing Andy Dyson, the CEO of ISLA, for the closing session. Andy gave my guest the accolade of having the craziest beard of any of the webinar participants, a very high honor indeed. So now it's time to introduce my guest, who I recently described as the Steve Jobs of our industry, creative, disruptive, and questioning. I give you Mark Faulkner. Mark, welcome to Pierpoint Perspectives.
Well, thank you very much, Roy. I feel like I should be hearing the music of Desert Island Discs in the background there. And to Andy's point about my lockdown beard, thank you very much, Mr. Dyson. I have been accused of looking rather like the actor Tom Hanks in Castaway. So I don't know what more to say about that. Thank you very much. It's a pleasure to be with you, Roy.
Yeah, I was thinking more Grizzly Adams, but Tom Hanks probably more correct. Although the length of it, I think is more Grizzly Adams.
You wish.
Right, Mark. So in preparing for the show, we came up with a couple of good reasons why we should be talking about this episode. But at the close of my last podcast, I said that Basel IV was much more significant in terms of its potential impact on our business than SFTR would be. And given the ructions and the time and the effort and investment that's gone into SFTR, that's a pretty bold statement. So we're going to be talking about that today. But in your own words, why do you think people should be listening to this episode?
Basel IV will have a dramatic impact upon the capital markets, and securities finance, be it lending, borrowing, repo, prime brokerage, is an absolutely critical component of those capital markets. The primary issue ahead of the industry is that banks that have been using their own internal credit models, supported and regulated by their supervisors, to manage their RWA, their capital, their balance sheet, their allocation, drive their pricing, etc. Post the implementation of Basel IV, will no longer be able to do that. And therefore a counterpart such as a fund, such as an unrated broker-dealer, such as a hedge fund, such as a mutual fund, such as a sovereign fund, that has no rating derived by the credit rating agencies, the bank will no longer be able to depend upon their internal calculations to allocate RWA. And the default position will be 100% RWA, which will make it significantly more expensive from a capital perspective to do business with these counterparts. Now, woe is me, another banking regulatory challenge. The banks are not the primary concern here. It's the follow-on impact in the capital markets across the marketplace, the savings, the pension funds, the sovereign wealth funds, the hedge funds that need access to the intermediary capabilities of these banks, the counterpart capabilities of these banks, that will suffer. And that's why it matters. And this isn't a small Excel spreadsheet thing. This is something that pulls together risk management, capital management, CFO. It's a major challenge. And the banks, some of them, very prepared already, Roy. It's coming in it was January 22. It's now January 23 because of COVID. I think it's an excellent decision to delay. But it matters to the entire marketplace.
So I guess capital is the most scarce and precious resource that banks have. And so if this is going to cost them more capital, I guess that's the basis of why it's so important. But look, why don't the pension funds and hedge funds and the other intermediaries or the other end users, either as borrowers or lenders, why don't they have credit ratings already?
Well, it's a great question. Some of them, very few of them, do have one. And I think one has to look at the structure of the credit rating business model and the way it's been done historically to answer that question. So if you and I worked at a company and we were setting that up and we wanted to grow and we wanted access to the public capital markets, we may well decide to interview and retain the services of a credit rating agent. And why would we do that? Not for our own edification. We'd want it so that that rating would be in the public domain and support the issuance of our paper, our bonds, our securities, that people, organizations that require a rating being a certain level could therefore buy those securities and create liquidity. S&P, Moody's and Fitch, the three dominant incumbent providers in that space, have a 95% market share. They rate in total about 16,000 individual entities. They get paid to rate them. They do that because they rate in turn about 2.2 million issues that stand on the shoulders, if you like, of those 15,000 ratings. Funds are historically not raising money, not issuing securities, and therefore that linkage, that demand is not there. It's also expensive to get a rating that is a public rating. I'm not suggesting in any way that it's the wrong price, because a lot of work needs to be done. 4,500 analysts are employed by these rating agents, and they do as best they can a good job. We've all seen or read the book, The Big Short, and some of the challenges in that marketplace are there to be seen. What we would say is that the issuer pays models is one of the challenges that stops ratings being more available, more widely available. And that's why funds won't pay the fees, because they don't actually issue securities themselves. There is no demand for that to do it. And if there were, because of the many, many thousands of funds that are existing, it would be prohibitively expensive for an asset management to seek such a thing. There are ratings that you might be familiar with in, say, the Morningstar Investment Star Quality ratings, but very typically a fund will not have a credit rating.
Yeah, so I was going to bring that up because the whole subject of ratings is often used by market participants as a proxy for something else, and it's often a challenge when talking to a customer and they say, "Oh, well, we go by the credit rating." And while I understand that, I always point out to them that the credit rating of a particular issue of a bond that a company has made is the credit rating agency's assessment of that company's ability to meet the coupon payments and the final maturity amount. It's not really an assessment of the company itself in that sense. It's just about its ability to meet the financial obligations of any debt it's issued.
Yes, and more importantly than that, there is something that we should all be aware of. Many credit rating agents, the big three that I've mentioned, are incorporated in America. They are technically nationally recognized statistical rating organizations, NRSROs, and they are regulated by the Securities Exchange Commission. And there's a reason why they're in America. They're in America because under the Constitution, the written Constitution, one of the amendments there, or one of the stated articles says that you have the freedom to express an opinion. If anybody looks at the documents coming out of the rating agencies, you will see that they are American and under the Constitution looking to express opinions, and that these opinions, and it says in writing, are not to be used to underpin investment decisions, which is extraordinary. I'm reminded of the little buds that you buy, cotton buds at either end of a little bit of plastic, earbuds, right? Well, the first thing that you read on the packet that contains them from Johnson & Johnson, the typical provider, says, "Do not stick in your ear." It's a little bit like that.
Yeah, and I think that's a great analogy because, in fact, the credit rating agencies become a de facto decision maker for a lot of investors who don't want to put the time or effort or don't have the resources to do an analysis of a counterparty or anywhere where they carry exposure.
It's the inevitable conclusion of this being an issuer pays model. It means it's free at the point of consumption to some extent by the people that are unqualified, incapable, or don't have the resources to do the work themselves. And it's created a false level of comfort around the use of these ratings for investment management decision making. And that's not what they're designed for. It says so on the can. We were recently asked by the Bank of England and Her Majesty's Treasury to provide data to help them support the COVID commercial financing facility. It was a very proud moment for Donal and I and the team at Credit Benchmark. We had not thought that our little credit company, our credit data aggregating business, would be in a position to be called upon. And what we found is the primary reason that we were asked to provide data to help this decision making was because in the UK, there were only about 230 companies that were willing to pay for a credit rating. But we had consensus developed in our data set, maybe we could talk about that later, Roy, which gave 2,300 credit consensus ratings. And it was that insight that enabled us to be able to provide data that was useful. And so our credit data had turned into information that was helping decision-making about liquidity, about solvency, and I don't think it's too overstated to say survival of companies in the UK and jobs. And we're very proud to do that. And that is a good use of data.
Yeah, and for those listeners that aren't aware of it, effectively the UK government was willing to provide financing to companies, large companies that were able to issue paper. And the government quite rightly said, well, we're happy to make funding available and provide liquidity during this period of uncertainty and crisis. However, we want to make certain that we're only lending money to entities that are likely to be able to pay it back. And as a taxpayer, I'm quite happy the government is taking that perspective. And I can kind of envisage the government saying to one of the UK banks or all of the UK banks individually, well, tell me which of these companies are good and which ones are bad. And we'll make our decision based on that. And each of those companies, each of those banks saying, well, quite frankly, we don't really want to share our view with you because it's our internal perspective. And anyway, it's only our perspective. So I can see the kind of scenario where one of the banks that had been involved with Credit Benchmark says, well, rather than getting our opinion and the opinion of the bank down the road, why don't you go and get this aggregated opinion, right? So is that kind of how it happened, Mark? And if so, maybe take us into a little bit of what Credit Benchmark is and how we came to be where we are.
Thanks, Roy. I mean, I think that is exactly the point. If you think about a bank and what a bank does, it's an organization that at its very core has to have credit capability, credit analytical capability to be able to choose the organizations to lend money to. It's not just about return on capital, it's return of capital. So they have that capability. And partly because of the credit crunch, banks have really emboldened this capability that they have to effectively run their own credit rating capability. Our insight was that using the kind of business approach that we'd established at Data Explorers, as a contributed data-based business model, which is very, very familiar in, say, the CDS market with Totem, in the earnings estimate with IBIS, etc., etc. Bloomberg do a lot of these kinds of things. We thought, why not do it for credit? Why not do effectively for the credit markets and providing credit intelligence what we did with Data Explorers in the securities financing business? And so with a confidence born of naivety, we went to the banks. And we said, hello, you don't know us. We've been introduced to you by the head of prime brokerage or securities lending or repo. Would you please let us have on a monthly basis the output of the regulated models so that we can calculate an aggregate that will be helpful for you to understand whether you're cavalier or conservative. You can benchmark your credit. The clue's in the name. To which most of them said quite politely, don't let the door hit your ass on the way out. But we're persistent people, as you would know from the years that you and I have known each other. And we kept going and we found a proof of concept. And you're absolutely right. Banks can't share data with one another. Banks can't share data publicly on the creditworthiness assessments they make. But properly, securely, confident in the capability of the counterpart that they choose, they can aggregate this data. Working out credit and the creditworthiness of funds or corporates or financials or subsidiaries, the people you actually do business with, where you have risk, not so they can actually issue securities, is a very powerful thing. The skin in the game credit assessments that organizations such as banks are doing are very, very valuable insights into their view of the creditworthiness of counterparts. Not an abstract theoretical game, but a real game. And so we've built up that capability. In the UK, we are now proud to say we have all of the major banks. We've got 37 banks contributing data with more on the way. And the point that the Bank of England recognised was that this data was valuable when they were looking at who to support, which companies needed help and were asking for help, and that were a good credit risk. As you're quite right to say, as a taxpayer, we don't want the Bank of England lending out money willy-nilly. We want them lending out money to counterparts that will have a capability and a willingness to pay the money back in due course. And the best way to understand that, perhaps, is to look at collected, aggregated data coming from the banking community that serves them on a day-to-day basis. Skin in the game, forward-looking, frequently aggregated data is a powerful credit consensus rating.
Well, I guess there's a few things that spin out from that. I guess number one, the whole idea of aggregating data and providing a range of views on any given entity is kind of akin to me to the exercise that many of us will have gone through in our bank training days, where you go through the proof that individual decision making is usually less effective than group decisions. And so one bank's view of an entity might be correct, but it's more likely that you'll get a correct view if you have 5, 10, 15 banks rather than one, where you might be right or they might be wrong.
Yes, the power of a group making a decision is, I think, well proven rather than an individual decision. However, it is fraught with challenges. When we talk to regulators about what we do, nearly always the first question they ask us is, what about mean reversion? Do you think about what a regulator or a supervisor is trying to do? They're trying to herd the cats. It's difficult. They want to herd them, but not too tight. They want to herd them, but not too tight. And it's a challenge that everybody wants to try and be aware of as you're looking at the data, which is why we don't prescribe the answer. Anybody who's read The Hitchhiker's Guide to the Galaxy will know the answer's 42, and so the rest of it's all pointless. But the joking aside, we provide a consensus, a range. And what we find is that certain banks with certain counterparts or sectors or geography have a propensity to be different. They want to be different. Why? Culturally, client mix, history, experience, the kind of things that don't necessarily throw up in, pop up in pure numbers. The analysis and the being a banker isn't just about the numbers, but the numbers do speak volumes.
Look, I've always said this, and we've had this conversation already, that numbers are just the starting point, not the end point.
Yes, very much so.
But one of the issues you must face, though, and I'd be interested in your comments on this, because if you're talking about, right now, 37 banks talking about the same entity, isn't there an issue in terms of having commonality of data that they're sending to you and having comparable data and comparable outputs? So how does that work?
That's a great question, and one that I've learned to answer, accompanied by my colleagues in the banking practice. So Michael Crumpler, Werner de Witz, and others have been great tutors in this field. The answer to the question is that we chose the banks, the largest banks, the most regulated and best supervised banks, and we chose the outputs of their regulated models. We took their view, their proprietary information, their view of the creditworthiness of the counterparts. We did not choose to have sight of, nor are interested in, to the many differing variables that they could possibly be gathering information on. That's down to the bank. That's known by the regulator. Furthermore, we didn't actually look to score one bank's model as better than another, because if the largest regulators and supervisors in the world were satisfied, we felt that we should be satisfied. So we took the outputs of the models, not the inputs of the models, nor ranking the scale of the models. I think that was an important decision. We like to say that we're much more scorekeeper than referee. And I don't know if that translates, but we want to be a neutral provider of comparable data. Why is it comparable? Because the banks are regulated to try and use this data for their own internal risk management capabilities, supported and overseen by their supervisors, for their capital calculations, their reporting, etc. This is the data the banking regulators get, and that's why it's so high focus for the organizations that contribute the data. And this is the data that they use for capital, for reporting, etc. So it's that communality of purpose, not communality of input and model, that gives us that comfort, Roy.
And I guess that's quite a good assessment of how you are not a replacement for credit rating agencies, but you're actually an alternative view, because the credit rating agencies are actually doing the analysis of the company or the issue of the particular bond and making an assessment based on the characteristics of it. So they're actually in there doing that. So you're the opposite end. You are actually taking the outputs from people that have made those decisions and aggregated it. Is that how you'd see yourselves?
Yes, I think we would, and I think all due respect to the credit rating agencies for doing the best that they can within the model that they observe. I think that we have a great deal of respect for them and others in this field. Our data is complementary to that data. Our data is an insight to what people with skin in the game think. Are they always right? Absolutely not. Are they always wrong? Absolutely not. Are they directionally right in most of the cases? Yes. Our data focuses on the entities, but it is, to bring it back to, say, a securities finance conversation, something that we can leverage off. This benchmark could be a means for example, pre-trade focus on the entities that you want to do business with so you can understand their RWA. Not your view, Roy, not my view, but one that we can have a benchmark reference price to, or reference to. For example, after the trade is made, the allocations that agents do often mean automatically borrowers have different counterparts. That's not something that normally happens in conversation with a desk. But the RWA implications of changing it to an entity that I may think is a very high RWA entity means that these are the kinds of things that our data could be used to sensibly monitor. So working with the players in the marketplace and the technical way in which pre-trade analytics is done and SFTR is processed, we can make sure, with reference to the benchmark, that the RWA impact is not something that's going to penalize the borrowers unnecessarily. Because as you said earlier on, capital, RWA, is one of the most expensive and most scarce resources around.
You know, I've been talking for some time about my vision, I don't know, maybe 6 or 7 years of this, where you're talking about from end to end, from the end user, the hedge fund or whatever the trader is that wants to borrow securities, filtering through the prime broker to the lender, be it an agent or a principal, but actually piping all the way down to the beneficial owner that the borrower determines is best, and best being collateral, RWA, fees, whatever the size, stability, all of those factors. So the challenge is that assessment, that credit risk assessment all the way through that channel.
Absolutely. And the problem is that, take that problem, and it would be a challenge with 10 beneficial owners, 100, 10,000, tens of thousands. That's the scale of the challenge. And if every bank who has a model wants their model to be the prevailing input into these calculations, they will disagree. There will be breaks. There will be stalemate. It will not happen. So you need a common reference point. And our argument, and this is not about a commercial for Credit Benchmark, our argument is that we've done the work with the core credit. And this is why we're popping up in securities financing events. Leverage off the benchmark to facilitate pre-trade matching, to facilitate ongoing matching, and to make this part of your decision-making process. If it can be referenced against a benchmark that is acceptable to 37 banks, most of whom have a major part to play in securities finance, it can be automated, Roy. And that's when the benefits, the efficiency, the cost savings start to come into play. Credit is one component of securities finance. KYC, operational due diligence, agency lending disclosure, SFTR, all depend upon this input being something that can be determined and used by the organization. But if you can unlock the power of the benchmark, you can start to reap the benefits of the efficiency of the processing of the capital and feed this automation, which you, I, and many others have seen as necessary in this market going forward.
Well, look, I think that the challenges are pretty clear for securities finance. Basel IV, to me, it makes a lot of sense. Just principle-wise, it makes sense to me that regulators want to look at what banks are doing and saying, you know what, the whole idea of you using an internal benchmark and your own internal modeling for figuring out how much capital you have to set aside is at its core an internal conflict. The people that want to get the most benefit out of the least allocation or the lowest allocation of capital are the ones that are coming up with the models that say how much they should keep aside. So I understand the regulatory objective, but we have a real world out here that we have to deal with. And Lehman was a great example where many lenders discovered after the Lehman default the huge range of Lehman entities that they were in fact exposed to, probably a tiny percentage of which had credit ratings. So that's on the one end of things, lenders dealing with borrowers. But the other way around, where all of these beneficial owners who never really issue debt in any shape and don't see any really reason why they should have a credit rating, well, they potentially are going to be disadvantaged without that credit rating. So we have a huge issue. That's why I think it's so fundamental.
Yeah.
And so tell me your thoughts on that.
Right. So having worked at Goldman Sachs and Lehman Brothers, I've got an interesting sort of perspective. It was a while ago, but I'll tell you a story. Goldman Sachs and Morgan Stanley, when I was there, sort of late 80s, early 90s, when you and I met. And it was Joe McManus that wouldn't take the meeting. I think you mentioned before. There's a bit of fun there. We love you, Joe, if you're listening. Goldman was fascinated by Morgan Stanley, and Morgan Stanley was fascinated by Goldman Sachs. And so very often, as people are talking and listening to prospects and customers out in the market, someone would come out, Morgan Stanley's doing this. And the first person would often say, there's no such thing as Morgan Stanley. It's Morgan Stanley Singapore. Is it the parent? Is it the UK entity? Is it one of the special purpose vehicles? Is it Frankfurt? Is it Japan? And that's a really, really good point, and it ties to your Lehman observation. It's often the case that the headline holding company may have paid for a rating because it wants to issue debt. But the entity that you're actually doing business with, and this is something that we certainly see in the community at large, is the organizations you have exposure to are not necessarily the names that you know best. It's the entity that you actually do business, the subsidiary, the trading company, the beneficial owner. There is no such thing as BlackRock. There's BlackRock Asset Management, but there's thousands of funds underneath BlackRock. There is no such thing as Morgan Stanley. No disrespect intended to many friends at Morgan Stanley. It's the entities that you deal with that you need to focus on, which is why the CDS market is not the answer to this problem.
Yeah, I mean, the CDS, I've always questioned why people use CDSs, because it's not really relevant other than maybe as a directional tone of sort of a peer group.
I would agree with that. I mean, sorry for interrupting, Roy. The CDS market is useful. It's a hedging, trading vehicle. It is not, and it should not be seen, and is not seen by experts, as a pure credit insight. It is something else. The volatility of the CDS market should also not be seen as a proxy for accuracy. It is not. It's just a volatile market that reflects trading conditions and different people's opinion. Often
at a given point in time.
Absolutely. And you have to deal, perhaps, to come back to the Morgan Stanley analogy, you're dealing in risk at the parent level, not at the transactional level, not at the subsidiary, the trading company you're actually doing business with.
Now, for people that haven't worked at a bank and don't have the experience that we have, the obvious thing for them to say is, well, okay, so if this entity doesn't have a rating and that one does, well, why not just have that be the entity that I book my trades to? Why doesn't that work?
Well, because particularly if one was looking, say, at the supply side of the capital markets, the buy side, less than 1% of the buy side has a rating, probably materially less than 1%. Many sovereigns don't have a rating, and governments, countries don't have a rating because they don't want to pay for one. They don't see the need for one. They don't want one. And so the supply side, the buy side of the capital markets is largely unrated. That includes everything from mutual funds, pension funds, insurance funds, sovereign wealth funds on one side. the hedge fund community is not typically rated either. And so it matters, because if you choose to only deal with rated entities, you will not be at the epicenter of the capital markets. You'll be dealing with a very, very small subset of the potential counterparts that you might choose.
Right. And from the borrower side, the reality is the booking entities are the ones where the capital is, where the trade is. And while you can intersperse other layers to get you to a rated entity, that adds cost and moves the lender into a disadvantaged position, because they say, well, look, I can only book for this lender into that entity. I've got a cheaper alternative, and they'll just give that trade a miss.
Absolutely.
So there's economics driving it.
Absolutely. Economics is at the heart of a market. I think there's another very highly related point, which I don't mind, I'll just tease out. The classification of a counterpart is an issue. You think that might be an administrative term, but in actual fact, it matters whether an organization is a government or a pension fund. So in the world of sovereign wealths, when you look at, say, for example, the government of Singapore pension fund, is it a government of Singapore, or is it a pension plan for the people of Singapore? Now, I think most people, most organizations would view it to be a government, and therefore from an RWA and capital perspective, from a classification perspective, the answer is clear. But I can tell you that not everybody agrees. People directionally know what they'd like the answer to be and what they think the answer should be, but changing that answer, if someone has taken a view that it's a pension fund, is extremely important. It has a major bearing. So, as we all know from years in the business, the devil is in the detail.
And I'll give you a similar story from my last employer. I signed up a sovereign wealth fund into our lending program. 2 borrowers from the same country with the same regulator had completely different outcomes of their assessment for that sovereign wealth fund using their internal risk model. And the regulator in both cases, of course, had to approve the use of that risk model. And so you have the same regulator getting 2 different views from 2 of its leading banks and coming up with different opinions, and somehow that's okay. And I think that's what Basel IV is trying to remove.
Yes, it is. But the good news is that the collective wisdom of organizations with skin in the game is accessible. So, for example, to just dwell on the classification issue, we realized that because we are trying to make sure that we deal with exactly the right entity when we get a credit opinion out of the models of the approved banks, that we wanted to make sure that we had that. So we would ask supplemental questions. Give us the LEI, give us as many identification as you point. Give us the country of risk. Give us your classification of what you think it is. Do you think it's a government, or do you think it's a pension fund? And so we're able to, as scorekeepers, share with our clients not what other people think, but the modal average, the count of people that think it might be a government or pension fund. Now, that is a reassurance or a challenging position once you have the data. I think that inconsistency that you very clearly pointed out a moment ago is a situation that is repeated time and time again. There are about 100 to 200 entities that really matter to get this right. The challenge is changing a decision is very difficult. You need support and empirical evidence to support it. They self-select to be large, so the issue, the maths, the numbers, the capital really, really matters.
Okay, look, Mark, I've taken quite a lot of your time today, and I know you've got other things scheduled. So I'm wondering whether you have any closing thoughts that you want to share with people.
I think what I'd like, thank you for the opportunity. I really enjoyed this, Roy. I hope that your listeners will do too. And, I'd be delighted to hear from you how it goes. And if anybody wants to get in touch, I'm sure they can find me. I think the most important thing I'd say as a human being, these times are incredibly testing, and I think the opportunity to communicate in a variety of different ways, such as this podcast, I hope is a useful sort of distraction for people, a useful source of information, but also a reminder that it's relationships, it's knowledge, it's the sharing of knowledge and relationships and the telling of stories that's really important to people at these difficult times. I've been on a few webinars. This is my first podcast. I had to look up what a podcast was. So thank you very much for holding my hand and taking me through it. I've never even listened to one, and I dare say I'll listen to this one to see how it comes across. One other thing I'd like to say is, and do forgive me, you and I have worked together and been counterparts and shared many stories and experiences over the years. I just wanted to say how much I've enjoyed and appreciated the time that I've had to spend with a couple of people who have just recently left our business. John Straccadanio is stepping down from Scotiabank after many years, and I know you know John well. And also Alex Ehrlich has just recently let go of the helm of the prime brokerage business at Morgan Stanley. If they're listening, I want to thank them for their support and time and enthusiasm and criticism and jokes. And I just really want to thank you, Roy, for the opportunity to answer your questions. I've had a lot of fun doing so. I hope it's been informative, and thank you very much.
Okay, well, thanks, Mark. I just want to correct one thing you said a moment ago, and that is technically this is your second podcast recording. I'll share that with listeners at some point, but the first time we recorded this, I had a technical glitch. So I really appreciate you taking time the second time out, Mark. Listen, people will be able to find you because in the show notes, we always provide a lot of detailed information on how people can get in contact, any papers, some of the things that we've discussed today. So there'll be a rich compendium in the show notes. So listen, Mark, thank you so much for taking this much time today and the time you took the last time we started recording it. I'm sure this is your first podcast, but it won't be your last one. I have a list of about 15 other questions, so maybe you can join us again sometime in the future.
I'd be delighted. Thank you very much, Roy.
Okay, thanks. And everyone, that's a wrap. I'll come back to you in a moment with the things that I learned from this session. So thanks again, Mark, and goodbye.
Goodbye.
And that's a wrap for episode 10 of Pierpoint Perspectives with our guest, Mark Faulkner of Credit Benchmark. I have 4 takeaways from that episode, and I hope you found it as interesting as I did. The first is Mark mentioned Alex and John as 2 of the people that he'd worked with or interacted with for many years and that have recently left the industry. So first of all, I'm not certain that anyone really ever leaves the industry, and you can never tell when people will pop up again. So it's probably one of those watch this space kind of things. But those of us that have been around for a long time have worked with some really great people, some real sort of industry experts that have helped shape where we are today. And that's the best part of the job. You get to learn from people that are smarter than you or have a different perspective than you do. And that informs your own opinions and views. You work with them, or you have them as customers, or you're their customers, or you just have engagement in public and private forums. And of course, in my job now, I get to interview people like that. And so that's one of the things I love about what I'm doing today. And Basel IV, as the second point, is one of those issues where, I was aware of it. It was on the horizon, but I didn't really appreciate the full impact of the business or of the new regulation. And the reality is, regulators, in my view, quite rightly want to see companies move away from internal models. They also want companies to be dealing with rated entities as a way of making certain that they're actually taking a view that's informed and not just informed based on those internal models which they've used. And so Basel IV will penalize dealing with entities that aren't rated. You can still deal with them, but it'll be costly. But we also talked about with Mark as point number 3 that the existing ratings infrastructure deals well with bond issuance and sort of copes with that. But the structure and the nature of it means that there's a relatively limited scope for reaching the huge array of market participants in the securities finance business, from the hedge fund end users to the beneficial owners and funds and investors that make those securities available for loan. And so we have to find, as point number 4, a different way of dealing with that. Not a substitute, but something that's complementary to that. And Mark took us through Credit Benchmark. It'll be interesting to see how this gets accepted. The reality is 37 banks contributing information. By definition, as we discussed, group decisions are generally better than individual decisions. And just like with the securities lending data available from any of the securities lending benchmark data providers, the reality is what you want to see is what's your view, and then what's the range of view of your peers. Is something too expensive or too cheap? In this case, is this credit rating that we have for an entity, are we too lenient or are we too conservative? And what are the range of views and where do we sit inside? So it's not just where do the numbers come out, but as we said, numbers are the starting point, not the end point. So lots to think about there. I hope you enjoyed it. As I mentioned, we always have things in the show notes, so there'll be lots of links that we get from Mark and that we add to it. I hope you enjoyed it. If you have other ideas and other guests that you'd like to see us have on the program, please send them through. We always appreciate the feedback on that. You can find us all over LinkedIn, both individually as the Pierpoint members as well as Pierpoint the firm, where we're Pierpoint Financial Consulting. You can find us also on Facebook under the same name, and we're on Twitter as Pierpoint FC. So that's it. That's a wrap for another episode. Thanks for joining us on Pierpoint Perspectives, and I look forward to catching you next time.